Okay, so question 4A. So 4B. 4B. Question 4B. We are told that the Rofters Group comprises two companies, namely W Limited, Z Limited, and Z Limited. W Limited is a trading company with two divisions. The design division, which design with turbines and suppliers, there is something missing, to customers at a license, and gearbox division, which manufactures gearboxes for the car industry. Z Limited manufactures components for gearboxes. It sells the components globally and also supplies W Limited with components for its gearbox division. The financial results for the two companies for the year ended 30th or 31st December 2017 are as follows. So we have that. The cost of sales in the gearbox division includes the cost of components purchased from Z Limited. Now evaluate the performance of Z Limited and each division of W Limited using the following performance measures. So that question is on performance measurement. That question is on performance measurement. So performance measurement. And we are told to do we have division, or maybe that one I call it let me call it details instead of division. Details. So we are told to get return on capital employed. Return on capital employed. Return on capital employed. The next one is asset turnover. Asset turnover. And the last one is operating profit margin. Operating profit margin. So how do we get return on capital employed? It is income you divide by capital employed. Capital employed multiply by 100. Asset turnover, how do we get asset turnover? It is revenue you divide by assets. You can leave it as a ratio, or you could choose to multiply by 100. Operating profit, this is income. You divide by revenue. You divide by revenue. You can multiply by 100. So those are the two formulas that we require, the formulas that are required for us to answer this question. So we can start with the design division. Start with the design division. Now for the design division, you can see the income or the operating profit is 6,000. So you will take 6,000, you divide by capital employed. Capital employed, we are told, is 23,540. 23,540 multiplied by 100%. What is the answer? 25.49%. So that is for the design division. Let us come to huyu mwingine anaitwa gearbox division. Gearbox division. You dance the same rhythm, that the profit is 38.75. And the capital which is employed is that 320. 320 times 100. What do you get? 11.99. 11.99%. Huyo mwingine anaitwa Z Limited. Z Limited. The operating profit is 70/10. 70/10. You divide by the capital employed of 82,975 times 100. Nasema 8.45%. 8.45%. So maybe because we have been told we rank, or we evaluate the best performer. We could add whatever, best performer Best performer as far as the return on capital is employed, that is design division. So design division is the best performer as far as return on capital employed is concerned. Yeah, I can see your answers, Royce and Ivarin. Good. Okay. We proceed now to get the asset turnover. Asset turnover. So asset turnover, we already have the formula that says it is the revenue. So you will take 14,300. You divide by the assets. The assets in this company, they are how many? How many assets? Capital turnover is the other word for assets. Capital, ukiangalia how the statement of financial position is drawn, the first part is for the assets. The second part ndio tunaletanga capital. So they are supposed to be equal. And where they have given you assets, it is always total assets less current liabilities. It is always total assets less current liabilities. So that means this capital is still our assets. So 23,540. It is 0.61. And the meaning of that is that for every 1 shilling of assets, we are able to generate 0.61 of revenue. We're able to generate. Haya, tukienda kwa huyu mwingine, revenue yake ni 25,535. 25,535. You divide by that 2,320. What do you get? 0.79. 0.79. Then this other guy or this other company, it has a revenue of 15,560. 15,560. You divide by 82,975. 0.19. So in terms of the asset turnover, who is doing better or best? Is Gearbox. Gearbox is the best. Gearbox division is doing the best. Next now is the income here, 6,000. You divide by the revenue. The revenue is 14,300 multiplied by 100. 41.96%. This other one is 38.75. You divide by the revenue of 25,535 times 100. 15.18 cents. And this other one has 7010 as income, and the revenue is 15,560. %. So who is doing better? Z Limited is the best performer. Now, as I've always told you, for practical purposes, not for exam, the meaning of this is for every 100 shillings you make as sales, you have a profit of 41. Hapa, you have a profit of 115 shillings. And here, you have a profit of what? 45. Now, one good thing that you should be able to see here is that these guys, they have not made a lot of profit. No, no, 15. Sorry, a lot of revenue. They have 15. But these guys, they have made a lot of revenue, 25. But their profit is kidogo sana compared to. The other day I was reading the results of Airtel. And they were saying that their losses have moved, I think, from 3-point-something billion to 5.6 billion. Despite the fact that their market share has moved from around 14% to around 27%. Actually, in the words of the CEO, he said, customers are loving us. Customers are loving us because of our low costs. They have reduced their prices. And you could be one of those customers. That's why we have dual SIMs. Airtel, Safaricom, M-Pesa. So these guys, because of our low price, they are generating, they have many customers. That's why their share has moved from 14 to around 27. But at the end of it, they are making a huge loss compared with Safaricom, which I think is still reporting an increase in profits. So the issue, the key thing is not this revenue. Look at the profit that you are making in every 100 shillings of revenue. Or for every 1 shilling of revenue, how much is your profit there? That's what you should focus on so much. Good. Actually, on a lighter note, the other day I was talking to Mr. Afra and he told me he's very happy with this program. Very happy with this program. Because although iko na wanafunzi wachache compared na vile kulikuwa previously, it is able to pay for the teachers. So you are sure the revenue you have collected is covering your costs. As opposed to where you have a big number, but ukienda kulala bado una amani because unashangaa how you will meet the bills. So that is the way forward. Don't be deceived by this. Look at what are you receiving from that. That was on the right note. Okay. Tuende now question 5. B. So question 5B. Trans Limited supplies a product branded BBG. Although the annual demand for BBG is high, it varies considerably. The demand during lead time and the associated probabilities are as follows. So we have Trans Limited places 5 orders. The ordering cost amount to that, carrying cost is that, estimated stock out is that, the order point is that, and then we have the lead time. So your device. So that question, because we have been handling similar questions, I just want to go straight without listing the 5 items. I told you there are 5 items that you are supposed to identify. There are 5 items that you are supposed to identify. So this is question 5B. And it's on inventory controls. The issue of safety stock. The issue of safety stock. So we say here, you begin with the new reorder point. New reorder point is what you begin with. Then you bring the safety stock. The safety stock. Then you bring the holding costs. Then you have shortage units per order cycle. Per order cycle. Multiply by probability of shortages. Probability of shortages. You multiply by annual orders. Annual orders. You multiply by unit shortage costs. This gives you total shortage costs. Total shortage costs. Total shortage costs. And then you will have total costs. So design a table like that. Makena, remind me after the lesson, I will give you the answer for that. Remind me immediately I'm through with the lesson. Good. So if you are through with the drawing, you tell me finished. So I think we have finished. Aaron, we are through. Ibarine, Royce. What about Jack? McKenna, good, good. So we can begin. So I told you that we always begin at the current reorder point. So the current reorder point, we are told is 850. We are told it is 850. So with 850, we have no safety stock. We have no safety stock. Therefore, there is no holding cost. So we come to this one. Now, you can only be out of stock if you get demand greater than 850. And when you look at the demand during needed time, the first greater is 900. So if you get 900, you will record a shortage of 50 units. A shortage of 50 units. And the probability is 0.05. 0.05. Plus, if you get a demand of 950, if you get 950, you will report a shortage of 100. And the probability of that is 0.04. 0.04. Plus, if you get demand of 1,000, you will be talking of a shortage of 150. And the probability is 0.03. 0.03. You multiply, I think that is all. Oh. So at 1050, that would be 200 with the probability of again 0.03 plus 1100, that would be 250 multiplied by a probability of 0.02. So this one now, we multiply by annual orders. The question is very clear. We have 5 orders. Then multiply by the shortage costs. which is 5,000 per unit. So work out that and give me the answer. $55,000. So that 55,000, what online, are you agreeing with that? 55,000. Is it 55 or 550? To getting 55. Online, waiting for your answer. It is 550, yes, Ivarin, 550, yeah? Yeah, 550,000. So sasa hiyo ndio itakuja weke hapa. 550,000. 550,000. So let us now try the next one of 900. At 900, you will have a safety of 50. The difference between this and 850. So the holding cost will be 50 times, according to information 3, it is 1,000. So this one I can assist you, it is 50,000. That is 50,000. So you can already be out of stock at this point if demand goes to 950. If you go to 950, you will have a shortage of 50 units with a probability of 0.04. Or if you go to 1,000, a shortage of 100 with a probability of 0.03. Or if you go to 1050, a shortage of 150 with a probability of 0.03. Or if you go to 1100, a shortage of 200 with a probability of 0.02. Now this one multiplied by 5, multiplied by 5,000. Three? 337,500. 337,500. So online, yes, Ivarin. Wengine. So when you add these 337 to these 50, then you tell us 387,500. 387,500. Let us go to 950. 950, you have 100. So this would be 100 times 1,000. And that gives us 100,000. That gives us 100,000. So you can be out of stock if you got 1,000, a shortage of 50 with a probability of 0.03. Ukienda 1150, a shortage of 100 with a probability again of 0.03. If you go to 1100, a shortage of 150 with a probability of 0.02. So you multiply by 5, you multiply by 5,000. $187,500. Yes, Ivarin. Wengine mko online, you are so quiet. So this is 287,500. Yes, Royce, good. Even Jack, good. Haya, twende kwa huyu mwingine wa 1,000. At 1,000, you will have a safety of 150. So 150 times 1,000 is 150,000. So you will be out of stock if you go beyond this, and this will be 50 units with a probability of 0.3. Or when you get to 1100, that will be 100 units with a probability of 0.02. And that one you multiply by 5, then you multiply by 5,000. $87,500. So ukiongezea hii itakuwa what? 237,500. So 1050, where now you report 200 as the safety. So 200 times 1,000 is 200,000. So there you can only be out of stock if you get to 1100. That would be 50 with a probability of 0.02. Multiply by 5, multiply by 5,000. 25,000. So hiyo ukijumuisha na 200, that gives you 225,000. So then from there, we go to 1100. You can have a safety of 250. So 250 times 1,000. That is 250,000. So there you cannot have a shortage. You can't have a shortage. So unakuja huku unatuambia ni 250,000. Tell us it is 250,000. So we said what you do, you select the minimum of these costs. And that happens to be this one. That is the minimum. So based on that selection, you now do a summary . Now do a summary. And in the summary, I told you, you should give us 3 things. One is optimal safety stock. Optimal safety stock. So that is the number of units corresponding to your selection. This one, so we are going to advise for 200 units. And based on that, you now advise on the new reorder point, which is 1050 units. And then you tell us probability of stock out. Probability of stock out. You can only be out of stock if you take that. If demand turns to be 1100, which is 0.02, which is 0.02. So that is how you summarize that question. If you are okay, you can say yes so that proceed. Yes, Zivarin, Jack, Royce. It's McKenna. Eren, are you okay? Where we have gotten the 0.02, this one, is because we have recommended that now the new reorder point is this one. So if you are here, you can be out of stock if demand is more than this. And demand being more than this is 1100. So the probability of demand being 1100 is 0.02. Hiyo. So unachukua probability yenye iko hapo chini. Is that okay, Helen? Good. And in case, for example, you had settled for this one, here 1000, the probability of being out of stock, it is the probability of this plus this one. So ukisema ni hii 0.02 plus 0.03. So you have stock of 0.05. So we now proceed to May 2017. So May 2017, question 1. So question 1A, we are told Frahia Limited, an events management company, is considering whether to advertise an outdoor concert. The sale of tickets is dependent on the weather as indicated below. If the weather is poor, it is expected that 5,000 tickets will be sold without advertising. There is a 70% chance that the weather will be poor. If the weather is good, it is expected that 10,000 tickets will be sold without advertising. There is a 30% chance that the weather will be good. If the concert is advertised and the weather is poor, there is a 60% chance that advertising will stimulate further demand and ticket sales will increase to 7,000. If the concert is advertised and the weather is good, there is a 25% chance that advertising will stimulate further demand and ticket sales will increase to 13,000. The profit expected before deducting the cost of advertising at different levels of ticket sales are as follows. So we are given all that. The cost of advertising the concert is expected to be 15 million. Now, using a decision tree, advise the management of Frahia Limited on whether the outdoor concert should be advertised. Should be advertised. So that question is on what we call multiple stage or stages decisions. Decision making. And as you know, when you're dealing with a decision, obviously is to know the objective. That's the first thing. So whoever is in charge of this company is out to maximize profits. That's given. And then after you know the option, the objective, you seek to establish the options. Options are what can be controlled by the decision maker. So this company is very free to make two choices. One, whether to advertise, and number two, whether to do what? Or whether not to advertise, yeah. And then, when you get to know the options, you need to identify the outcomes. Outcomes are two. Rather, outcomes are also called states of nature because they are beyond control. So what will happen here is matters whether, that is beyond control, and matters demand. Matters demand. So based on that, we need to come up with a sketch. We need to come up with a sketch. So we are debating here on whether we need to advertise or not to advertise. Whether we need to advertise or not to advertise. Then, when we advertise, the weather can either be good or poor. If you don't advertise, the weather can be good or poor. And then, whatever is the case, if you have advertised, there is a possibility of stimulating demand. So you either stimulate or you don't. You stimulate or you don't. But if you have not advertised, that remains. That remains. So with that, we have 1, 2, 3, 4, 5, 6. We have 6 tables. We have 6 tables. So with that now, we can start to design where we have the payoff here, and we can have our figures in thousands. So this is where I'll do the fair copy of the decision tree. So we have said we are debating on whether to advertise. So there is an advert or no advert. Whatever you decide, the weather can either be good or poor. The weather will be good or poor. Then demand can either increase or we say no increase. No increase. You can increase or no increase. So we are told the probability that weather is poor is 0.7 and weather being good is 0.3. So this is 0.3 and 0.7. 0.3 and 0.7. Then we are told if the weather is good, you can sell 10,000 tickets without advertising. So this is 10,000 tickets. And if the weather is poor, without advert, you sell 5,000. But if you advertise and the weather is poor, there is 60% chance that you will stimulate and demand will increase to 7,000. So you have advertised and it's poor. Advert poor, you will increase to 7,000. So if you are increasing to 7,000 with a probability of 0.6, that means no increase is 0.4. No increase ni kumaanisha unasimama tu mahali where you are poor without advert. And poor without advert was 5,000. So that now we say we talk 5 to 7. Have increased 5 to 7. Then if you advertise and the weather is good, there is 25% chance that you stimulate demand to 13. So the probability is 0.25, so no increase is 0.75. And we are told you can go to 13,000. So you are going to 13,000 from the 10,000. This one which does not have the advert. 10,000. So these ones will help you get the profits. So unaangalia hapo tu mahali kuna 13,000, it is 150,000. Mahali kuna 10,000, it is 90,000. 7,000 is 35,000. 5,000 is minus 20,000. 10,000 is 90,000. And 5,000 is minus 20,000. And we are told the advert will cost 15 million. So hapa kwa advert, weka 15,000 in brackets. So I want you to design such a smart diagram. And after you design, down there, you give me these results. Down there, you get these results. Below the table, you will have the node and the expected monetary value. So I expect you to go all the way to the end. And if you have any question, you register the question. So we are finished. Those who are online, kuna mwenye amesema finish. But I believe you have been able to say node 1 is 0.25 times 150 plus 0.75 times 90. Ukapata ngapi? 105. I'm using my figures in millions. My figures are in millions. Then for number 2, it is 0.6 times 35 plus 0.4 times minus 20. Ukapata 13. Then when you go to number 3, it should be 0.3 times 105 plus 0.7 times 13 minus 15. What did you get? 25.6. Then number 4, it is 0.3 times 90 plus 0.7 times minus 20. You got 13 again. So number 5, you go for the higher EMV. The higher EMV at nodes 3 and 4. And the higher is 25.6. Na hiyo imechukuliwa kwa number 3 here. So you come and mark that way so that below your workings now, you offer your advice. You offer your advice whereby you tell these guys that it is good to do the adverts. It's good to do the adverts. It's good to do the adverts. And closely related to that, if they were to ask you value of information, value of information, I told you what you do. Unakuja hapa hii ya mwisho, hii unachukua the highest. Kama ni moja, ni mbili ama tatu. The higher or the higher. So the higher hapa ni 25.6. You might ask the next one. The next one is number 3. That is rather number 4, which is 13. Because the argument is when you have information, you go for the best, this one. So if you don't have the information, you will go for this one. So you will lose how much? 12.6. So if you want to get a consultant to advise you, that is the maximum you should be willing to pay. So when you are using a decision tree, that is how you get the value of information. You're okay, sema yes. Let's solve it to part B. Here's Ivarin. Helen's okay. Jack, Royce McKenna. McKenna, we are waiting to hear from you. Okay. Proceed. So part B now inasema, okay. Samoa Limited has to decide which of the 3 new mutually exclusive products X, Y, and Z to launch. The company's directors believe that the demand for the 3 products will vary depending on competitors' reaction. There is a 30% chance that the competitors' reaction will be strong, a 20% chance that the competitors' reaction will be normal, and 50% chance that the competitors' reaction will be weak. The company uses expected value to make this type of decision. The net present values of the possible outcomes are as given. So a market researcher believes that he could provide perfect information to potential competitors' reaction in the above markets. So advise the management of Samoa Limited on the maximum amount that should be paid for the information from the market researcher. So 1B is on what we call SIGO stage, decision making. SIGO stage, decision making. So the question says we advise on the maximum amount that should be paid. So the maximum amount to pay is what we call value of information. Is value of information. So how do you get value of information? Where value of information, when you are in the SIGO stage, it is given as expected monetary value with information minus best expected monetary value without information. So EMV with information. EMV with information. How do we get it? So how you get the EMV with information, I have already said a while ago that someone who has information, they go for the best. So for each outcome, you pick the best. So ukiangalia outcome ya strong. Ukikibia na strong, the best is how much? 1200. So you will take the 1200, and the probability that these guys will be strong is 0.3. The probability of a strong reaction is that 0.3. Then, ukikibia na normal, the best is also what? 1200. And the probability that they will just react normal way is 20. Hiyo ingine is 1600. And the probability is 0.5. $1,400. So that is the EMV you can get if you have information. Then let's now see how to get we have the option here, and we have EMV without information. So we have this one, we have product X. You realize to handle information, they take a lot of time to accomplish something small. That's all. Today I was talking to someone, I was telling me he met someone who is 25 years and is almost completing PhD. Akashangaa yeye ako na miaka ngapi na mahali amefika. You are saying it is a function of the information. So huyu mtu kama wazazi wake wako na information and the ability, amesoma first degree, masters, PhD. Lakini wengine wetu taba ujue what should be done. And even after knowing what should be done, taba you gather the ability to do it in terms of finances and other things. It will take a lot of time. So that's why the one without information upper, computations are involving. So for product X, ukifuata X, when we are strong before 100, and the probability of strong is 0.3, if it turns to be normal 600, with a probability of 0.2, and if it is weak 1,000, with a probability of 0.5, okay, yes, Zivarin, 740. That's all. Good, confirmed. Right, let's go to product Y. Y is 800 with 0.3 plus 1200 is 0.2 plus 1600 with 0.5, 1280. Yes, Ibarin, 1280. Then we go to product Z. Product Z, we have 1200 with a probability of 0.3 plus 800 with a probability of 0.2 plus 1000 with a probability of 0.5. 1020. Yes, Ivarin, I can also see that. So the best here is this one. So we will be anaitwa the best. And with that, maximum amount to pay. Maximum amount to pay, which we have said is value of information, value of information. It is then the EMV of 1400, alafu hii 1020, and that gives you how much? Created. Huh? Oh, sorry. It is 1280. It is 1280. Sorry for that. It is the best is 1280 here. Three. It is 120. So that is the maximum money, amount of money that should be paid. So are we okay with that? Those who are online? Yes, Mwalimu. Jack, Aaron, Royce. Because I can see I have around 20 minutes. It will take more time. I think question 2B would take more time. And therefore, I want to go to 3C. 3C, maybe we can finish. Then the next lesson, God willing, we go back to that other one. So look at 3C. Look at 3C. Wonder whether we can be able to complete it within the 20 minutes or so. So question 3C is on what we call budgetary control. Budgetary control statements. So in this one, I don't know whether you should divide fast. How much the items to ensure that we don't squeeze. Hapa just allow space here like 2 lines. Or just 1 line. Two lines there, up there. Shaacha hiyo itakuwa na column inaitwa details. And the first item will be units. Ikifuatwa na mwingine anaitwa percentage. Ikifuatwa na mwenye anaitwa percentage. So if we just follow what is in the question, we have sales, less, nataka kuipindua kidogo, variable costs, you less variable costs. So the variable costs, we have materials, we have labor, we have overheads, we have overheads, we have selling, we have administration. Administration. When you do that, the figure you will get is called contribution. Is called contribution. Then you say less fixed costs. You less the fixed costs. The fixed cost, I have 3. I have labor. I have selling. And I have administration. Administration. So that I have net profit. So that I have net profit. So that is where my column for details we get to. Not left any. Okay. Now we always begin with what we call original budget. Original budget. And this one, let us call it B. Let us call it B. Hiyo haina mambo mingi, itafika tu hapo. So the units of the original budget we just copy the way they are. If we say our figures are in thousands everywhere, then Original budget is 640 units. And I told you the original budget is always assigned 100%. Then we copy, the revenue is 1024. Variable cost, material 168. Labor 240. Overheads, that 2. So give me the contribution. $584. Fixed costs, labor is 100. Selling, that is fixed at 70. Nilisahau. Wenye nilikuwa nafikiria nimeweka vizuri hii space yangu. Nimeshangaa mbona nimetoshea kubwa. Haya. Sijali, for you to be a good food, you must know how to build and to demolish. So where's variable cost? So ya kwanza ni material. Ya pili ni labor. Then I have overhead. Labor, overheads, and selling. 168, 240, 32, 144, and 48. Good. So that gives us a contribution of 392. Fixed labor is 100. Fixed selling is 72. And fixed admin is 184. That should give you the profit that is shown there, 36. That's all. Tukibia kwa actual results. Actual results. And we call them C. Actual results, and we call them C. So going to the actual results, the units are 720. So divide this 720 by 640. Multiplied by 100. Tell me what percent is that? 112.5%. You divide 720 by 640, you'll do what percent is that? Tuanze kuweka the values 1071. Huyu mwingine ni 144. Huyu mwingine ni 288. Tukifuatwa na 36. Ukikibia kwa sales variable ni, is it 453? That's very high. 453. And then the variable is is 153, not 453. That's a typing error. Yeah, we suspect. It's very So Ivarin, you are saying is 153. It's very high. So give me the contribution based on that now. $396. The labor that is fixed is 94. Huyu mwingine selling is 83. And the admin is 176. And confirm whether the profit goes to 43. Okay. So let's go to the flexible budget. The flexible budget. And we call it D. So the flexible, I told you what you do. These ones that are variable, revenue and the variable costs. Unachukua hii 1024 multiplied by 1.125. Then 168 multiplied by 1.125. 240 multiplied by 1.125. 32 multiplied by 1.125. 144 multiplied by 1.125. 48 multiplied by 1.125. So 48 times 1.125, I have 54. 144 times 1.125, I have 162. I have 36. 240 times 1.125. This is 270. 189. 1024 times 1.125 is 1152. Minus 189. Minus 270, minus 36, minus 162, minus 54. Are you getting 441? Those who are online? Okay, Karim saying yes. So sasa hapa units nilisema unaleta hizi za the actual. And the percent, hiyo ndio imefanya tuende tukimultiply. The percent that way. Tuko sawa, eh? Then I told you the fixed costs remain as per the original budget. They don't change. So hapa kwa labor tutaleta 100. Hapa tulete 72 na hapa tulete 184. So do that and give me the new profit value. So we now need to do the variances. Umesema profit ni 85. Yeah, good, good. I have 5 minutes remaining. They will be enough. So variances, we have two categories. Tuko na ile ya kuchukua original budget minus the actual. So B minus C. B minus C. Then tutakuwa na the flexible B minus C. Those are the two types of variances. You remember when we first of all came across this statement, we never computed these variances because we have not covered. Sasa hii, these ones, they are what the other day we called the exposed. So they may not be very similar with the ones that we get when we use the formulas. But the interpretation is the same. So tuende kwa, tutaanza tu hapa kwa revenue, tuanze na hii. 1024 minus 1071. It is a variance of 47. But we need to say whether it is favorable or adverse. You see, the budget was 24, but the actual 71. So that is favorable. It is favorable because we were able to report a higher revenue. Tukikuja kwa cost, utasema ni 68 minus 44. 24. Sidio? This one is favorable because we spent less. It is favorable, we spent less. 40 minus 88, it is 48. And this one is adverse, because we spent more. Huyu mwingine is a difference of 4, which is also adverse. We spent more. It's adverse, we spent more. Huyu mwingine is this is 6 plus 3, 9, 9, which is adverse also. And this is 2 plus 4, that is 6. And that is also adverse. Then, tukuja hapa. This one is is 6 and is favorable because we spent less. This one we have 11, which is adverse. And this other one is 8, which is favorable. So this one should be 4. This one, how you get it, is just to add these variances. It's just like what we are doing with the reconciliation. So utasema, tumekuwa tukisema uchukue 47, you add the 24, which is favorable, you less the 48, you less 4, you less 9, you less 6. You get 4, which is favorable. Now this 4, you're here. Naona hii 92 and 96. Haya, sasa hiyo ongezea 4, ongezea 6 minus 11 plus 8. You give us a favorable of 7. A favorable of 7. Then finally, let's go to the other one. Tutakuwa tunasema 1071 minus 1152 is 81. So this one, 81, you can see the budget was more than actual. So when the budget revenue is higher than the actual revenue, that is bad news. So that is adverse. Maybe before I forget, why these ones are called the more realistic, is you see, when you are using these ones to measure performance, this manager will be promoted because he has reported a favorable of 47. But when you become real and you appreciate changed circumstances, the truth is 81 advanced. So this is a manager you should fire or you should punish. That's why these ones are said to be better. Whether kwa huyo mwingine 144 minus 189 is 45, and that is favorable. Something else that I may also need to emphasize. Unaona hii hizi zimefanana in terms of the interpretation, eh? Lakini ukitumia hii, huyu mtu utampea kaliwadi kadogo compared to this one. Haya, 288 minus 270 is 18, and because it's a cost, it is advanced because we spent more. 36 here is 0. Huyu mwingine ni 53 minus 62, it is 9, which is favorable. Hii ni 0. So now ukichukua 81, which is negative. You add 45, you less 18, you add 9, you end up with a 45 adverse. Now your 45 ni hii na hii, this and this. Then for the fixed, this is 6, which is adverse. No. It's favorable. We spent less. We spent less. This is also 11. And it is adverse. We spent more. This is also 8. And it is favorable. We spent less. So plus 6 minus 11 plus 8 is 42. Advance. So we call it a day at that point. Jack, ni wapi unasema 48 advance? Oh, I hope ni ile ya uko. So we call it a day at that point and hope to meet tomorrow. Thank you so much. Good night. Have you finished copying? Was you online? We have finished, you say yes. Okay, I can see Varin is through. Aaron, Jack, thank you. Royce, good. Yeah, thank you so much.